Welcome, traders and investors, to TradersArmy.com's Strategic Options Trading web series. Here's where we start to get into more advanced strategies, specifically focusing on a lot of different spread trading strategies. Before we go into the actual strategies themselves, we have to really define what the heck is a spread trade anyway. And I want to remind you guys that you can reach out to us at any time if you have any questions about this or any other topic at TradersArmy.com regarding your trading and investing. And you can reach out to us at this email address, support@TradersArmy.com. Remember, we're happy to help in every way that we can. So in options, if you've gone through, or if you haven't gone through, I suggest you do, our Options Foundations web series, we know that we can take 4 possible actions or combinations. In the first part of our web series, we were focusing on single leg positions, just a single call option that we were buying or selling to open a position, and then we could turn around and close those positions by unwinding it, taking an opposing order. So if we buy to open, then we go ahead and sell to close that option. If we had sold to open an option as a single leg position, then we would buy to close it in the event that we wanted to get out of it or hold it through expiration. But if you hold an option through expiration, what do we risk? Well, we really risk losing all of our money associated with the premium. That's one, losing all of our money associated with premium if we've paid it. But even more importantly than that is we risk automatic exercise of our options or automatic assignment on the options that we have sold. So oftentimes we want to stay away from the expiration date, especially if the option itself is in the money. So we don't have that automatic exercise or assignment going on in our accounts. Now, not the end of the world if so. It just depends on if you have the money in the account to actually take the assignment or exercise your rights. That's when it could get a little bit dicey within the options account. But again, if you've made it this far to our spread trading web series, then you probably already know a good portion about how that works anyway. If not, I would highly suggest going back through the Options Foundation web series to make sure that you do. Now, when we are buying call options and put options, remember we are always paying the premium and we have the right to exercise that contract as long as we want to exercise it before expiration date. Now, the seller of calls and puts receives the premium. They will again carry the obligation to either buy or sell the underlying, depending upon whether or not they sold a call option or a put option. And they would have a very specific outlook when doing this as a single leg position. But now we're going to start to get in to having multiple option positions on the same stock at the same time. Okay, so when we go through and we use the checklist, remember the checklist has not changed. We still have to remember that we have to go through the trading checklist. It's not even just a stock or an options trading checklist. It's just a trading checklist. Remember, it's important you don't skip a step, and you must go through these steps in this order. So first, we recognize again where the broad market is. That's the S&P 500, the NASDAQ, the Dow, the Russell 2000. The broader stock markets. Then we dive into the sectors and we analyze which sectors are relatively strong or weak. And then we go into the stock screening and selection of a particular stock, and we check the news, we check earnings, we check any sort of FDA announcements or stock splits or dividend announcements, things like that that could affect our trade positively or negatively coming up. And then we want to build a trade on that stock using our entry criteria, our stop criteria. That's for protective purposes, our targets, and make sure that we understand what our risk reward is on the underlying, as if we were going to trade the stock outright. Now, if you want to get more detailed on what the rules are and the approach and the actual strategy for the first 5 steps here, then go to our advanced price action web series, and that'll focus on this part of the checklist, which is focusing on just the trading rules as they stand. So once we move past this, then we could go into the option market. If we choose to trade the stock, we can stop right there. Okay, if we choose to trade the stock, we don't have to go any further than that, except for placing the trade, journaling the trade, so we can kind of look back and reflect on that trade. But if we don't really want to trade the stock because there are options available to trade on them, then we go through these steps here, making sure there's enough liquidity in the options, the bid-ask spreads are narrow enough. We take a look at implied volatility to make sure that we understand the volatility environment. Are we overpriced, underpriced, or fairly valued in our options? Choose the option strategy for our outlook on the underlying and where we expect volatility to go in the future, and analyze the risk reward on that option position. Use our position sizing exercise to appropriately position size for your personal account, and enter the trade with all stops, alerts, any targets, so you can walk away from the trade and let it play out. And really the key to strategy selection is volatility. Now you have to have an outlook on the underlying itself, the stock itself. So that comes from reading price charts. So the price charts tell us whether or not we are currently low in price, high in price, whether we believe the market will go up from where we're at or down from where we're at or stay pretty well sideways. But that's the directional outlook on the stock itself. To trade options, we have to know where volatility is and whether we're not in the upper 20%, referring to short options positions, the lower 20% of its 1-year range, looking at buying or long options positions, or if we're in the middle somewhere, looking at some very specific spread trades that we would be using to offset some of our volatility exposure. And that really is what a spread trade is designed to do. A spread trading strategy consists of multiple option positions on the same underlying at the same time. Typically, I would say mostly, a spread trade will have one long leg and a short leg. So you're going to buy one option and sell another option on the same stock and be long and short on that same stock at the same time. Now, you might think, well, why would you want to do that? Then you don't really have a directional bias. Well, remember, we have different strike prices and different expiration dates when dealing with options. And so we could be long a different strike price than we are short. We could be long a different expiration date than we are short. Okay. And when we talk about a leg is simply one single option position. So a multi-leg trade is a spread trade. It's going to have more than one option position on the same stock at the same time. And you can get pretty advanced. You can actually go out and have 2 legs on a trade, 3 legs on a trade, 4 legs on a trade, and they get more complex. The trading strategies get more complex as we get more legs on one stock at the same time. And what's important to understand is, why do we even use spreads? Why bother? Okay, because number one, if it all boils down to where is implied volatility, and we go back and we say, well, if implied volatility is in the lower 20% of its range, then sure, we can just go out and buy calls and puts. That's fine, and that's an ideal strategy. But what if we're not in the lower 20%? What if we're right here in the middle somewhere and volatility could drop or go higher from there? We have risk associated with buying options to volatility falling, and we would lose money if volatility did fall, which is why we only want to buy options when the outlook is bullish on volatility. It's the only time we want to buy outright options, and that's it. And what if we were looking at shorting options? Well, we want the short option, single option position, to be in the upper 20% of its volatility range for the last 1 year. Well, what if it's not all the way up here and we're somewhere in the middle? Well, we have volatility exposure. If volatility rises, we're going to lose money if we're short options. So we really have to have a number of strategies around the options market that allow us to hedge or offset risk associated with volatility. Now, in addition to offsetting some volatility risk or all of our volatility risk, we also lower the capital requirements when getting into a spread trade. So who doesn't like spending less money on an investment? So we get to spend less money, which reduces our risk. It increases the probability of the trade working out in our favor, and it reduces or enhances exposure depending upon if you want to reduce exposure to time and volatility, you can do that. If you want to enhance the exposure to time and volatility, we can do that as well. And ultimately manage our risk and our reward associated with the options Greeks. We're talking about delta, we're talking about time, theta, and we're talking about vega, which is our volatility exposure. So when you can spend less money increasing probability, reducing risk, and increasing reward potential, what you're going to find is that most professional traders and investors who are using options will most times use options spreads versus single option positions, single leg option positions. And while we're not going to go through every single option spread in this particular web series, we're just talking about what is a spread trade and why should we care. We will go through a number of spread trades in upcoming web series with very specific rules and guidelines and examples on how the different spread trades work. But there are quite literally a seemingly infinite combination of different option spreads creating a strategy for any market environment, up, down, sideways. And there are strongly bullish markets, there are moderately bullish markets, and there are mildly bullish markets. There are strongly bearish markets and moderately bearish markets and just mildly bearish markets. And then there are neutral markets where we would expect the market's going to maintain just sideways and not really go very far from its current price for quite some time. We need to be able to make sure that we have a strategy for that. And then also we have, neutral to sideways market environment right now, but with an upcoming earnings announcement or FDA announcement, we'd expect this catalyst to send the stock just through the roof rallying or collapsing almost overnight. And so we expect a lot of volatility in the future one way or the other. We got to have a strategy in our back pocket or in our toolbox, if you will, for all market environments. And options are really the only asset class out there that do provide us an all asset class tool. And so some are going to be more simple spread trading strategies and some are far more advanced. Some are going to be used regularly. Most of them are going to be used pretty infrequently, okay? And so we're going to focus in our upcoming web series on the ones that we would use more frequently. And the key here, folks, is don't complicate it. Keep it simple. I have educated, I got to estimate somewhere around 2,000 to 3,000 students in the markets over the last several years. And I have never really met someone who wanted to make it more complicated. We always want to keep it simple. But we as human beings have a tendency of taking something which could be simple or kept simple, and we tend to complicate things. Okay, so we are going to do what we can to keep everything simple. It is up to you when you're at your house, spread trading on your own, with your own account, to also do what you can to keep it simple and follow the rules. This is where having a checklist makes a lot of sense. Now, understand that options trading can be complex. It can be complex, no question, but it doesn't have to be complicated, okay? Now, when it comes to spread trading, there are three main types of spreads. These are really the foundational types of spreads that were going to be used to create more complex option spread trades. And these three main types of spreads are horizontal spreads, which consist of, again, buying and selling options on the same stock at the same time, using, very specifically, the same strike price, however, using different expiration dates for your long leg, which is the one you're buying, and your short leg, which is the one that you're selling. So yes, you're buying and selling the same strike price, but using different expiration dates, and there is a time and a place and a market environment that we want to use horizontal spreads. But then we're going to move on to a time and a place for what are known as diagonal spreads, which is again going long, buying, and selling, going short, options on the same stock at the same time, using different strike prices and different expiration dates. So different strike prices and different expiration dates. And then vertical spreads. Vertical spreads are probably the most commonly used when dealing in neutralizing time and volatility exposure, but a vertical spread allows us to buy and sell options on the same stock at the same time. So again, we're long and short options, same stock, same time, using different strike prices, but we're going to be using the same expiration date. Okay, so there's horizontal spreads, diagonal spreads, and vertical spreads. And when you look at what a horizontal spread is versus a vertical versus a diagonal, I want you to take a look at this graph here and understand what we've done is we have strike prices listed, the same strike price across the board here. So the $15 strike price across the board, 20 across the board, 25 across the board, 30, 35, 40, 45. These are $5 strike price increments across the board. But notice when we go across the board, we're using different expiration months. We're showing different expiration months as an example. So a horizontal spread would be where you were looking to purchase one option, say the 25 option, the 25 strike option in February, but then go out and sell a May 25 option at the same time. So you're buying and selling different expiration periods of time, but you're buying and selling the same strike price. And again, when we get to the horizontal call spreads and put spreads, that will be, we'll peel that onion back a lot more. But just showing you why it's called a horizontal spread is we're using the same strikes, different expirations. Well, a diagonal spread is using different strikes and different expirations, where you might be buying a 25 strike option that expires in February, but then selling a $45 option against it. So now you're long the 25 Februaries, short the 45 in Mays. So we've chosen to use different expiration months and also different strike prices. And again, there's a time and a place for diagonal spreads. And when we get into diagonal call spreads and diagonal put spreads, we'll peel that onion back and go deeper into when and why we would choose to use that spread. And then there's the vertical spreads, which again are going to be using the exact same expiration, just using different strike prices. So in this case, you may be looking at purchasing a $25 option, but then selling against it in the exact same expiration month, a $45 option. Okay, that's your strike price. And so when you use different strike prices, but the same expiration date, you are using a vertical spread. Now, a simple spread structure, so we're going to keep it simple, a simple spread structure using call options will always consist of a long call contract, so one long call, which means you're paying a premium and you have the right to buy the underlying. You have a positive delta position and a positive vega position, which means your outlook is you believe the stock will go up and you believe volatility will go up as well. But you have negative theta, which means time going by will negatively impact that long call position. A spread structure will also include a short call contract or contracts, which by itself receives premium, has the obligation to sell the underlying, deliver that underlying stock, has a negative delta and a negative vega position on its own, and has a positive theta value on its own, which means on that short call, you're actually receiving money, you're actually getting paid as days go by. So what happens when you actually do one long call and one short call? Okay, what happens? Now, disclaimer alert, everyone. What I'm about to show you is not an actual strategy or an explanation of a strategy or a description of a particular strategy. This is simply going to be an example of how being both long and short on different options affect the net premium, the net delta position that you have, the net theta, and the net vega when you combine two positions at once. So this is just a simple debit call spread example. And remember, a debit means you've paid money to get in the trade. Think back to your options foundation series, or think about your ATM or credit card purchase. When you make a purchase with your ATM card or credit card, money comes out. That is known as a debit. It is debited from your account. If money comes into your account, that is a credit to you. Okay, but in this case, we are going to be building or showing what the net premium and the net delta, theta, and vega position would be in a simple call spread example. Now, again, this is not an actual strategy that we're going to be discussing right now. We're going to be getting deeper into them in other web series. But if you take an at the money call option and you go out and you buy it, and let's say that the at the money call option is at a $40 strike price, that will cost you all on its own $5.25 a share. you'll carry positive delta, which means you need the stock to go up. Time is hurting the position, that's the negative sign, and volatility going up is a positive. And then you look at the short call position, which would be an out of the money, otherwise known as a higher strike call option at $50. That one, when you sell a call option, you're going to bring money in. So this is a positive. So money actually comes into your account when you do that. But you're carrying a negative delta position when you sell calls. You do carry a positive theta position, which means as days go by, you actually earn premium. You actually make money as days go by. Whereas if you're long the option, you lose money. And then Vega, it actually a volatility rise when you're short call options, when you're short options, volatility rising is actually a negative. That is the individual leg itself when you go across the grid. But when you come down and you look at the net spread result when you're both long and short these strike prices, your spread result is $10, which means if you have the right to buy the stock for 40, but you carry the obligation to sell the stock for 50, because that's the contract terms. You have the right to buy for 40, but you have the obligation to sell for 50. The most that this position could ever be worth is $10. It could be worth no more than $10. That is what the spread tells us. Now watch what happened. When you paid $5.20 to buy the calls, but then received $2.10 to sell the calls, you only have to pay out $3.15 debit because money came in offsetting your cost of the original long call. So what happens is we've just reduced our debit to $315 per contract, and which means we've reduced our risk to $315 per contract. If we had just purchased one long call and didn't sell these calls against it, then our risk would be $525 a contract. But by selling an option against it, we reduce our overall debit, which means we reduce our overall net risk. Now, we've also reduced our net delta position. So when you take a positive delta of 52 on the option you own and you subtract the 24 deltas that you sold, you actually end up with 28 net deltas. So which direction do we still need the stock to go? We still need the stock to go up in value. Now theta, on a long call position alone, we are losing money, but on a short call position alone, we are making money. When you subtract the amount of money you're losing, but add back in the amount of money you are making every day, our net theta goes down. Now, are we still losing money every day we're in this trade? Yes, we're only losing a penny a share, however. Whereas if we would just went long the call, we'd be losing 3 pennies a share per day. So we've reduced our overall theta exposure to time decay and vega. So a long call, we need volatility to rise. With a short call alone, we need volatility to fall. When you subtract your positive vegas or your negative vegas from your positive vegas, you actually get a net vega in the spread trade. Now, we still have a positive number here, but it's drastically smaller than just the long call. And this is a big reason why we do this, is to negate or minimize our exposure to volatility working against us and time working against us, really. So where do we need volatility to go? Well, because it's still a positive 4 cents vega per share, we still need volatility to rise in this position. If volatility falls while we're in this position, that's actually going to hurt us, but it's now only going to hurt us by 4 pennies per 1 percentage point. So not nearly as bad as the original long call position would have hurt us. And when we look at the net spread results, the risk is lower, therefore the reward potential would be higher. The delta risk is lower, the theta risk is lower, and the vega risk is lower. So while we have an increased reward potential, we have a decreased risk potential. Okay, so again, this spread could be worth no more than $10 at any one time. But watch what happens if you hold this position and the stock price actually moves up like we think it's going to. And it moves up and it goes well above, let's say it goes up to 50. It's way above 50, or it's just up to 50. the spread is worth the difference between the two. So if you can buy the stock for 40, but you have to sell the stock for 50, that spread is worth $10. But if you've paid $3.15 for something that's worth $10, you've got significant profit considering you paid $3.15 for something that's now worth $10. Okay, so you'll have significant profit potential if the stock makes its way above $50 per share. So again, not really focusing on the strategy or the setup at this point, just want to show you guys what it looks like to have a net spread result in a debit call spread. Now, the difference between a credit call spread and a debit call spread is in a debit call spread, money goes out of our account. It's a negative debit from our account. In a credit spread, money comes in our account. Now, how do we get money coming in our account to establish a position? Well, if you look at our short call is now the one that's at the money. So if we are selling a $50 call option, but then going out and taking some of that credit, which brought in $2.10 to our account, and purchasing an out of the money option, that is again a higher strike call option, maybe by the 60 strike call options, those are going to be out of the money, therefore cheaper to purchase. So if we received $2.10 credit in our account for selling these calls, but paid 65 cents for these calls, well, then we still have a net credit of $1.45 per share coming into our account. Now, let's take a look at our net position value. So when you consider the long call delta, theta, and vega, and the short call delta, theta, and vega, we come up with a net spread result. So the spread is still $10 wide. We're receiving $1.45 per share credit, and we have a net negative delta position because we carry negative 35 deltas on our short calls and positive 13 deltas on our long calls. So on the long calls, where do we want the stock to go? Up. On our short calls, where do we want the stock to go? Down. On our net position, where do we want the stock to go? Down. So we are bearish on this particular stock because we have built a net delta position, or negative net delta position, I should say. Now, theta, when you look at time decay, how is that impacting a long call? It's impacting our long call negatively, but it's impacting our short call positively. But when we have an at-the-money call option with greater theta than our out-of-the-money long call, we are still earning a little bit of premium every day. So our net theta position is actually positive 1 penny per share per day in the spread trade. And then volatility. In the long call all by itself, where do we want volatility to go? Well, we want volatility to go up. In the short call position, where do we want volatility to go? We want volatility to go down to negative vega position. But when you net out the two, you still want volatility from here to go which direction, if any? You still want it to go down. Now notice how greatly reduced, how almost near zero a lot of our theta and our vega really is in these examples, which means we have very little exposure to both time decay and volatility changes. And when you're dealing with a volatility environment that is not extremely high or not extremely low, you want neutral or near neutral vega. This way you're neutralizing your exposure to volatility moving for you or against you. Time decay is again one of those things that can be really almost completely negated when dealing with spread trades, while, by the way, maintaining a delta position, which means that you still desire and require, in this case, the stock to go down to make money. Okay, so with that being said, this is looking at the net spread result using simple call option examples. Now, when looking at a simple spread structure using put options, a spread trade using put options will still also consist of one long put contract or multiple contracts in which we have the right to sell the underlying when we pay our premium and receive the contract. We are carrying a negative delta position, which means we believe the stock will go down, and we are carrying a negative theta position because we bought the option. That option is decaying away from us or against us. but we have a positive vega position in the sense that we need volatility or desire volatility going up. And while we need the stock to go down, we'd like to see volatility go up. That's a long put. Now, when you add or take a look at the short put all by itself, a short put receives premium. And when we receive or collect that premium as a credit, we have the obligation to purchase the underlying stock. So we have the obligation to purchase the underlying. We have a positive delta position and a positive theta position, but we will be carrying a negative vega position in the short put all by itself. But when you go through and you actually net out the put example and you look at the puts from a debit perspective, have a look here. Now, when you're buying a put spread, you are buying, in this case, an at-the-money put. So let's say that we buy an at-the-money put, and that happens to be a $65 strike price. And that's going to cost us $12.30 a share to buy that option, okay, as an example. So that money comes out of our account per share immediately because we're buying the puts. But at the same time, if we go out and we sell a short put, sell short a put that is out of the money, this for puts is a lower strike option. So from 65 down to 45, so we're selling an out of the money put option, we're going to receive some premium. But because it's out of the money, we're going to be receiving some premium. We're not going to be receiving a bunch of premium. Now, watch what happens. The net spread result is the difference between the long strike and the short strike. That's the net spread result. So the most that this spread could ever be worth is 20 bucks. That's the most that this spread could ever be worth. Now the premium, look what happened to the premium here. When we paid $12.35 to buy one option and we received $7.15 to sell another option against it, our net debit is actually now reduced to $5.20 a share. So that's $520 that's going to come out of our account for this single spread trade. Now there's two option contracts here, one long and one short, but when you combine the two, you still have a net debit, so money's going to come out of your account to the tune of $5.20 a share in this example. Now look at what happens to our net delta, our theta, and our vega. So look at the long position all by itself. The long position on the delta is a negative position when you buy a put, which means you need the stock to go down. If the stock price were to go up, this would negatively impact the position. As time goes by, time going by will negatively impact this position. And as volatility rises, our vega says you'll make 12 cents per share per 1 percentage point that volatility rises. So we still need volatility to go up if we're just long the puts. If we're just short the puts, we're going to have the exact opposite. So it will have a positive delta, a positive theta, and a negative vega. Now, when you net out your negative 55 delta and you subtract your 21 positive delta, you're actually still negative deltas, which means which direction do we still need the stock price to go? We still need the stock price to go down because we have a net negative delta position. If the stock price were to go up in this debit put spread, then that would negatively impact our position and we would be losing money. As time goes by, we are still losing a bit more money on our long position than we are making on our short position. Therefore, we are still netting out a negative theta position, but not nearly as bad as if we just went long the puts. So we're still losing 2 cents a share per day. And volatility exposure is greatly reduced from 12 vega when we sold and received a negative 7 vega. We are still long, or positive in this case. Positive is another way of saying long. We are still positive 0.05 vega, which means that if volatility rises 1 percentage point once we're in the position, that's going to positively impact our position, and we can expect to make about 5 cents per share on volatility still rising. If volatility drops, that's a bad thing. If volatility rises, that's a good thing. Okay? So again, this strike price selection here is the spread result. The spread could only be worth a maximum amount of 20 bucks. Now think about this. If you paid something of a debit that is around $5.20 a share for something that could be worth upwards of $20 per share in the future, you have almost 400%, actually really more than like 300% return, potential return on your original investment. Okay. Um, Now, we'll discuss in the strategy section on debit put spreads what would need to happen for us to make that 300% return. But ultimately, when we reduce our risk because we reduced our cost, we can ultimately reduce our reward and get incredible returns on investment using spread trades. Now, again, just like the credit spread using call options, the credit put spread requires us to still buy and sell put options, but the options that we decide to buy and sell will result in a net credit coming into our account. So watch this. If we are shorting an at the money put, we're going to collect quite a bit of premium, $3.10 per share, relative to purchasing an out of the money put. An out of the money option is always going to be cheaper. So it's always going to cost us less to go out and buy it. So if we sell a $45 put and we go out and buy a $40 put, we're going to pay some money for the $40 puts, but we received money for the $45 puts. And the money that we received is greater than the money we have to pay. Therefore, our net result is a $1.05 credit per share coming into our account as a credit. So short the puts at 45 strike price means that we are under obligation to purchase the stock at 45, but we have the right to sell the stock for 40. So this position could not be worth any more than $5 per share. That's the spread of difference or spread value, maximum spread value. Now let's look what happened to our net result in our Greeks, delta, theta, and vega. When you're long puts, you need the stock to go down. Time going by is a negative. That's what our theta tells us. And volatility rising is a positive. When you are short puts, you carry the exact opposite delta, theta, and vega position. So you carry a positive delta position when you sell puts, positive theta when you sell options, in this case puts, and negative vega, meaning if volatility rises, that is a negative. So you carry an opposing Greek setup here to our long position. So these are going to net out when you have two positions on the same stock at the same time. So our net delta, because our short delta, the delta on our short option is greater than the delta on our long option, we still have a net delta that is positive 18 for that matter. So where do we need the stock price to go in this credit put spread? We need to see the stock go up. We need to see the stock price go up. Now for theta, we are receiving more theta every day than we are losing in our long options. Therefore, when we have a net theta of positive 4, we are still getting paid 4 cents per day to be in this trade. 4 cents per day per share to be in this spread trade. So that is time going by is a positive in this trade. And then we have our vega position. So our long position is positive 6. Our short position is this actually is more along the lines of 0.09. There we are, 0.09. So our 0.09 vega is more negative than our positive 6 vega. So we still carry a negative vega position, which means which way do we want volatility to go from here? Well, we want volatility to go down from here because rising volatility from here would impact our position negatively. So again, these are not examples of particular trades that we're going to be using. These are just setting up the examples on what happens, what goes on when we are both long and short options on the same stock at the same time using different strike prices. Again, we're not even focusing on whether or not these were horizontal spreads or diagonal spreads or vertical spreads. I just want to show you what happens when you start to net out the result of your premium that you're paying or receiving, when you net out the spread difference, when you net out your delta, your theta, and your vega. And the spread trades really do allow us to remove a lot of the cost, remove a lot of the risk, remove a lot of what could hurt us in the trade. by things working against us. And so when we can reduce our risk, increase our profit potential, increase our rate of returns, I think you'll learn to love spread trades quite a bit very, very quickly. Now, whether we use a call spread or a put spread would depend upon three things. Number one, your directional outlook on the stock itself, okay? The current implied volatility environment and the future outlook of volatility, meaning do we expect volatility to rise, go down, or stay the same? And we use volatility charts for that. And are there any upcoming events or news items or catalysts that could impact a trade? And again, there are going to be some trades out there that we're looking for some events. We're looking for some catalysts that are going to cause quite a bit of volatility in some of our spread trades. And those are going to be requiring a upcoming event or news event that causes great movement, and we're going to want that movement. Sometimes we don't want the movement, sometimes we do, but if we expect the movement, then we're going to build a trade around that. If we expect little to no movement, we'll build a trade around that. And oftentimes we're going to be using a spread trade to, again, minimize risk, maximize return, maximize reward, reduce our exposure to the things that can hurt us in everyday option trading. So as we move on to the actual spread trades and guidelines around different spread trades, always come back and refer to some of the fundamental principles of options trading. And again, if you have any questions about this web series or anything regarding your trades, just reach out to us, support@tradersarmy.com. Again, we're happy to help in every way that we can. Sometimes, actually, and a lot of times, having an army of traders, a community of traders working together can really rapidly increase the rate that you learn how to actively trade your options professionally, consistently, successfully. And anytime we can be of any help at all in helping you manage your risk, your reward, and fiercely protecting your capital, we are in full support of being able to do that for you. So reach out to us, let us know what you need, and we're happy to help in every way that we can. Until next time, take care. Thanks for joining us. Bye-bye.